In this class, we will talk about fixed income securities, their properties, the markets where they trade, and some of the important elements of analytics of dealing with fixed income assets, how we price them. Let's begin with the general overview of fixed income markets and securities. A fixed income security is a financial claim with promised cash flows of fixed amount and fixed dates. When we use the term fixed income, this refers to the fact that these securities are explicit about which cash flows are promised and when. This does not mean that they are risk-free. Obviously, there could be circumstances when these securities do not deliver the promised cash flows. There are various types of fixed income securities traded in the markets, and these form an important part of capital markets. We are going to mention just several of the major classes of fixed income securities. At the top of our list are treasuries. These are government bonds issued by various governments, US treasuries, Japanese government bonds, German bonds. These are used by governments to conduct their fiscal policy. In the United States, we also have debt or fixed income assets issued by the federal sponsored agencies, such as Fannie Mae and Freddie Mac, and these are the agencies that support the functions of the housing market, and they are important players in the fixed income markets. Municipal bonds are a little bit different from treasuries because of their tax treatment. Municipal bonds in the United States are exempt from the federal tax, and for the local investors, they are also exempt from the local state taxes. Corporate bonds are also an important and large part of the fixed income market. They come in various forms and shapes. They differ across maturities and various properties of securities that we are going to discuss a little bit later. Corporate bonds are issued by firms and are used to finance a variety of business activities. Finally, we should mention mortgage-backed and asset-backed securities, which are created using financial engineering, using the process called securitization. And these assets are based on an underlying pool of other more primitive assets, such as mortgages, car loans, student loans, and so forth. The following pie chart gives us a snapshot of the bond markets in the United States in 2019. As you can see here, there are three large segments of the market that capture most of the market value across fixed income securities. First, the treasuries. Treasuries account for roughly a third of the fixed income market. These are bonds issued by the US government. Second, mortgage-related securities. These are at a lower level than the treasury market, but they capture roughly a quarter of the fixed income market. These are securities that are backed by pools of mortgages. We also see that the corporate debt market is roughly of the same size as the mortgage-related securities and accounts for roughly a quarter of the fixed income market. We have several smaller segments, such as debt securities issued by federal agencies, Fannie Mae, Freddie Mac. These are at roughly 4% of the total market. Asset-backed securities, these are securities that are backed by pools of financial assets other than mortgages, car loans, student loans. These are at around 4% of the total market. And the municipal market is about 8% of the total. And finally, money markets, which are very short maturity securities, that stands at around 2% of the total market. What we can see from this graph is that fixed income markets are fairly heterogeneous. There are several large segments, and in our discussion, we are going to focus on some of these in particular. In today's lecture, our primary focus is going to be on the valuation of treasuries, and in the following classes, we're going to talk about pricing of corporate bonds. Next, let's consider participants in fixed income markets. It is convenient to think in terms of three broad categories: the issuers, the intermediaries, and the investors. This division is not exact, and some of the players in these markets play multiple roles and show up in different categories. Issuers in these markets are those entities that issue fixed income securities. These are the borrowers in fixed income markets. Governments are important players in fixed income markets. They issue treasuries, government bonds. Municipalities are the source of municipal securities, and corporations who issue corporate bonds. There are various intermediaries present in these markets that facilitate primary transactions, which is when a borrower issues the bond for the first time, as well as secondary market transactions. This is when bonds change hands and are traded among investors. We're going to highlight only a few of the intermediaries that are important. We have various kinds of dealers in these markets. We have primary dealers and other dealers. Primary dealers play a special role in the sense that they participate in the auctions of government securities. So they are the first ones to absorb the supply of government bonds. Other dealers facilitate transactions in the secondary market among investors. For example, a treasury starts its life by being issued by the US government. It gets sold to a primary dealer, which could be a large bank, and then it eventually gets sold in the secondary market to other investors. A bond can, of course, change hands multiple times throughout its life by being traded in the secondary market. Investment banks play an important role as intermediaries in fixed income markets. They serve multiple functions. They can act as a dealer holding an inventory of bonds. They can act as a broker, making matches between buyers and sellers of fixed income securities. And they can also help corporations or municipalities issue their bonds. So they can help in primary transactions. They can help structure bonds and place them with investors. An important class of players in fixed income markets are credit rating agencies. This is a somewhat unique feature. We do not see this kind of entity in equity markets. They are specific to the fixed income markets. As the name suggests, credit rating agencies such as S&P or Moody's serve to provide information about the quality of fixed income securities. They rate credit quality. They attach credit rating to different securities that indicates the relative riskiness. This information can be then used by the investors to decide on how to allocate their capital across different types of assets. We're going to look more closely at ratings of bonds and how they map into the risk when we discuss risky corporate bonds in the following classes. There are multiple types of investors in fixed income markets. Pension funds, insurance companies are big holders of bonds. In particular, insurance companies hold large quantities of corporate bonds, and pension funds also hold a significant amount of treasuries and corporate bonds of various maturities. Mutual funds hold portfolios of fixed income securities, and they can be viewed as one example of an entity which is both an investor and an intermediary in this market. If you think about a mutual fund as a holder of corporate bonds, then of course it acts as an investor. At the same time, mutual funds serve an important function of enabling individual investors to deploy their capital invested in a diversified portfolio of securities, and in that capacity, mutual funds serve as intermediaries. They connect individual investors to the broad fixed income market. Hedge funds are also players in multiple capital markets, including fixed income markets. We think of hedge funds as investors in these securities. They, of course, are also intermediaries because hedge funds ultimately operate with capital that they receive from their investors. Banks and individuals are also buyers of fixed income securities. Next, we introduce the concept of yield curve. Let's first consider cash flows of fixed income securities or bonds. There are three important characteristics that define a bond: time to maturity, the principal payment, which is the payment that the bond is promising at the maturity date, and the coupon. For example, the bond that you can see here is a 3-year bond with a $1,000 face value or principal value and a 5% annual coupon. So each year, bond investors receive $50 in coupons, and at the maturity date, in addition to the last coupon payment, they receive a $1,000 principal payment. We are going to value fixed income securities using absence of arbitrage, or the law of one price. we're going to limit our attention to situations where default risk is irrelevant and the only dimension we're going to focus on is the time value of money. In other words, we're going to develop arbitrage valuation for risk-free bonds, default-free bonds. Prices of various fixed income securities provide information that we need to value other cash flows, other risk-free cash flows. Markets provide various sources of information about prices of bonds. We could infer discount rates for different maturities from prices of pure discount bonds, these are bonds that do not pay coupons, from prices of regular coupon bonds, or from other fixed income securities. At the end of the day, all of these various securities are connected to each other by the law of one price or by essence of arbitrage, and we can use any combination of fixed income assets as long as it is sufficiently rich to infer prices of other fixed income securities. Next, we define the spot interest rate. The spot interest rate varies with maturity. The spot interest rate for maturity T is the rate of return that a fixed income investor is going to receive by investing today and collecting the payoff T periods from now, T years from now. Spot interest rates are indexed by their term, T. So when we talk about spot interest rates, we're talking about the entire term structure of interest rates. For each maturity, there is a corresponding interest rate. This collection of interest rates corresponding to different maturities is called the yield curve. If you look at the snapshot of the yield curve on the 8th of June of 2019, you can see that the spot rates differ across maturities. For example, if you were to invest for a period of 1 year, the interest rate, the risk-free rate in the market, would be 1.99%. If you invest for a period of 30 years, the interest rate is different. It's 2.57%. It is higher in this case. The shape of the yield curve does not stay constant over time. It varies. And next, we're going to discuss how the shape of the yield curve changes with economic conditions. On this graph, you can see the history of interest rates, or the yield curve, from 1977 until 2019. There are several lines on the graph which correspond to interest rates of different maturities. These are color-coded. We are looking at interest rates from 1, 3, 5, 10, and 30 years to maturity. One thing we can see is that there is a common component in all of these interest rates. They tend to move to some degree together. That's an important property of the yield curve. There is something common about movements in interest rates. Historically, what we observed is that over the last 2-3 decades, interest rates across maturities have been generally declining and are now at a relatively low level compared to the beginning of this sample, which was late 70s and early 80s. Another observation is that the difference between rates of various maturities does not stay constant either. There are periods when interest rates across maturities are quite different. Generally, interest rates on short maturity bonds, short maturity fixed income securities are lower than interest rates for longer maturities. There are times when interest rates seem to converge across maturities, and sometimes the yield curve even flips in a sense that short-term interest rates are higher than long-term. There is a correlation between these events and general economic conditions. What we have seen historically is that typically convergence of interest rates or inversion of the yield curve with the long rates declining relative to the short rates tends to happen at the beginning of recessionary periods. This is not an exact law, it is a statistical relation. Next, we talk about relative valuation of coupon bonds in relation to pure discount bonds or zero coupon bonds. First, let's consider the relation between interest rates and bond prices for pure discount bonds. This is a matter of definition. Interest rates can express the rate of return on the bond. Bond prices also express the rate of return, but in different terms. Bond prices and interest rates are directly related to each other. The relation is that the bond price with a face value of $1 and maturity T is equal to 1 divided by 1 plus the interest rate to power T. In other words, the price of the bond today is equal to the face value of the bond discounted at the rate of interest from now until the maturity date of the bond. if we are thinking of interest rates as the primary source of data, we can then express bond prices as a function of the interest rates. Alternatively, if bond prices are observed as the primary input, we can express interest rates as a function of the bond prices. A coupon bond pays a regular stream of coupon payments in addition to the principal payment at maturity. We're going to think of a coupon bond as a portfolio of pure discount bonds, where each of the payments delivered by the coupon bond can be visualized as a payoff over a single discount bond with the corresponding maturity. We are going to use law of one price or arbitrage valuation to establish a connection between the price of a coupon bond and prices of discount bonds of various maturities. We can also go in reverse. We can start with the prices of coupon bonds and recover implied values of discount bonds. Let's consider an example. Suppose we are working with a 3-year bond with a $1,000 principal payment and a 5% coupon. So in the first year, the holder of the bond receives a payment of $50, second year, $50, the third year, it's $1,000 and a $50 coupon payment. We can think of this bond as a sequence of cash flows that can be replicated by a portfolio of discount bonds. In this case, we need 3 discount bonds. We need a bond with maturity of 1, the bond that pays off at time 1, paying $50 at that time. We need a bond that matures at time 2, also paying $50, and we need a discount bond that pays $1,050 at time 3. Our coupon bond is equivalent to the portfolio of 0 coupon bonds. As a result, the price of the coupon bond has to be equal to the cost of the portfolio of 0 coupon bonds, according to the law of one price. If that equality was violated, then there would be arbitrage. For example, if the price of the coupon bond were to be lower than the price of the portfolio of 0 coupon bonds that replicate its cash flows, an investor could buy a coupon bond and short sell the replicating portfolio of pure discount bonds to lock in arbitrage profits. We can generalize this argument to any coupon-paying bond. Of course, there was nothing special about our 3-year bond, and we arrive at a general formula that tells us that the price of a coupon bond is equal to a sum across the dates from 1 to the maturity date of the bond, capital T, of the coupon payment of the bond times the price of the corresponding discount bond plus the principal payment P multiplied by the price of the pure discount bond paying off at time capital T. This is the formula that we see. The price of the bond is equal to the discounted value of its cash flows, where we're discounting them at the corresponding interest rate. As an example, suppose that the yield curve is given by the following information. The discount bond with maturity of 1 trades at 95.2 cents with a face value of $1. The discount rate with maturity 2 trades at 89.8 cents. The discount bond with maturity 3 trades at 86.3 cents, and so on. We do not need to know the prices of other bonds. For our exercise, now we're pricing the 3-year bond that we have seen. The price of this bond comes out to be $998.65, which is 50 times the price of a 1-year bond, which is 95.2 cents, plus $50 times the price of a 2-year bond, which is 89.8 cents, plus 1,050 times the price of a 3-year discount bond, which is 86.3. This is a special case of the general formula above. We now consider a more general bond valuation problem. Previously, we started with prices of pure discount bonds, and we figured out how to value a coupon bond. Now we're looking at the generic situation, where we start with prices of different types of bonds. Some are discount bonds, some are coupon-paying bonds, and we want to answer 2 questions. One is, what are the implied interest rates? What are the prices of discount bonds? And the second question is, if you observe an instance of mispricing, if some of the prices are inconsistent with each other, how can you take advantage of it? How can you build an arbitrage trading strategy? So to be specific, we have 3 bonds to start with, A, B, and C. A is a 1-year discount bond, paying $100 at time 1. B is a 2-year coupon bond paying a 5% annual coupon. And C is a 3-year coupon bond paying a 10% annual coupon. And the prices of these bonds are given in the table. A trades at $96 at time 0, B trades at $99.30, and bond C trades at $108.80. We're also given bond D, which is a 3-year discount bond with a face value of 100, and D trades at $84. The question is this bond fairly priced? And if it is not, how can we take advantage of mispricing? So to start with, we're going to collect given information in a matrix. It's a matrix of bond payoffs. And you could see that each of the rows corresponds to one of the bonds, A, B, and C. And for each of the bonds, we're tabulating their cash flows. Bond A pays 100 at time 1 and 0 afterwards. Bond B pays $5 at time 1, $105 at time 2 and 0 afterwards. And bond C pays 10, 10, and 110 at time 3. Now we're trying to find prices of discount bonds with maturities 1, 2, and 3 years. Let's call them P1, P2, and P3. Each of these bonds has a face value of $1. Let's relate prices of these bonds to the given bonds. For example, focus on bond B. This bond is equivalent to a portfolio of discount bonds, 5 units of a 1-year bond, and 105 units of a 2-year discount bond. So we obtain a pricing equation, 5 times P1 plus 105 times P2 plus 0 times P3 is equal to $99.3. We can obtain a similar pricing equation for bonds A and C. As a result, we have a system of equations, 3 equations, each one corresponding to a price of a single bond, and we have 3 unknowns, each one corresponding to a price of a discount bond, 1, 2, and 3. This system of equations has a unique solution, which you can compute, and what we find is that P1, the price of a 1-year discount bond, is 96 cents, P2 is 90 cents, and P3 is 82 cents. What we have done is we recovered prices of discount bonds, or in other words, we recovered spot interest rates from the collection of prices of various fixed income securities, different types of bonds, coupon bonds and discount bonds. Now, looking at our solution, we can see that the price of the bond D is not consistent with the prices of A, B, and C. D trades at $84, but the implied price for a 3-year discount bond is $82. So D is not fairly priced relative to A, B, and C. How can we take advantage of this situation? We are going to build an arbitrage strategy. Let's recall that an arbitrage strategy is supposed to be self-financing. It does not require any infusion of capital. It's supposed to be risk-free. There is no risk of losing money. And it's supposed to be profitable. There should be a positive probability of generating a positive cash flow. So we're going to construct a portfolio of bonds A, B, C, and D to generate arbitrage profits. Let's call our positions XA, XB, XC, and XD, respectively. And X refers to the number of shares of each of these securities in our portfolio. Our objective is going to be to generate a cash flow of $1 at time 0 and nothing in periods 1, 2, and 3. Of course, this is arbitrage. There is no risk of a loss, and we get $1 for free at time 0. That's the free lunch arbitrage. Now, this requirement can be expressed as a system of 4 equations. Each equation corresponds to the cash flow coming out of the portfolio in a given period. The first row corresponds to time 0, second time 1, 2, and 3, respectively. So now, for the first period, we want to generate a cash flow of $1. The cash flow that the portfolio produces can be computed as a function of the portfolio positions, X, A, XB, XC, and XD. In particular, when you buy a security, let's say you're buying bond A, you're generating a negative cash flow for each share you buy. the negative cash flow is equal to the negative of the price of the bond at time 0. At time 1, you generate a positive cash flow, 100, which corresponds to the payoff of the bond. And then, because the bond expires, at time 1 it pays nothing in periods 2 and 3. So, looking at time 0, the cash flow of the portfolio is going to be minus 96 times XA, that's the contribution of bond A, minus 99.3, which is the price of bond B, times XB, and so forth. So we're summing across all 4 bonds the size of the position times the negative of the bond price. The combined cash flow at time 0 is supposed to be $1. That's the requirement for our arbitrage strategy. At time 1, we want the strategy to pay off 0. So the cash flow of bond A times the number of shares, which is 100 times XA, plus the cash flow of bond B, which is 5, times the number of shares times XB, plus 10 times XC, that's contribution of bond C, plus 0 times XD, because bond D does not pay anything at time 1, that sum has to be equal to 0. And so we obtain the same kind of equation for time 2 and time 3. We have 4 equations on 4 unknowns. The unknowns are the positions in the portfolio for bonds A, B, C, and D. The system of equations has a unique solution, which we find. What we see is that we can indeed generate arbitrage profits. We knew that because prices were internally inconsistent. And to do that, we have to take a short position in bond A and in bond B. The size of the position is minus 0.0433 shares. We take a long position in bond C. The size is 0.4545 shares. And we short half a share of bond D. The strategy has no risk of a loss and generates a single dollar of profit at time 0. In conclusion, what this example illustrates is that when you observe a rich set of fixed income securities, you can infer prices of various other assets. You can price securities relative to each other. There are strong arbitrage-based restrictions on the relative prices of assets in fixed income markets. In particular, prices of coupon bonds can be used to infer prices of discount bonds, or in other words, spot interest rates. We can therefore recover the yield curve from the prices of coupon bonds. So far, we looked at arbitrage restrictions in a static framework. Our trading strategy was a one-short trade at time 0, which generated arbitrage profits. These arbitrage-based methods are more general than that, and they can be used in a dynamic setting that can be applied over time. To do that, we need to build models which are dynamic, that incorporate trading over multiple periods. And this is a subject for future lectures. Next, we introduce an important concept in fixed income markets called yield to maturity. If you open the Wall Street Journal or you look at quotes for bond prices on Bloomberg or another data source, you're going to see that bond prices are typically quoted not in dollars, but in terms of their yield to maturity. Yield to maturity of the bond is defined as the rate of return such that if it is applied across all of the maturities from 1 to capital T, then the discounted value of the cash flows paid by the bond is equal to the bond price. In other words, as you can see from the formula, if you pretend that spot rates across all of the maturities are the same and equal to yield to maturity, then you should recover the bond price. Yield to maturity is thus defined as the solution of this equation. Yield to maturity is a quoting convention. It's a way of quoting bond prices. It does not represent the rate of return that the bond investor collects. It is simply a way of summarizing price information of the bond in a way that's relatively intuitive. Yields to maturities cannot be used to compare bonds to each other. A bond with a high yield to maturity does not necessarily pay a higher return or represent a better deal to the investors. Again, these are simply quoting conventions. Based on the definition, yield to maturity is a somewhat complex weighted average of spot rates across maturities. It's a weighted average of interest rates. Consider the following example. Suppose that the 1-year interest rate is 5% and the 2-year rate is 6%. These are the spot rates. These are the rates of interest that investors can collect in the market. Now, consider a 2-year treasury with a principal payment of $100 and a coupon rate of 6%. This bond pays $6 in the first year and $106 in the second year. Let's apply the definition of yield to maturity to this bond. First, we compute the bond price. The price of this bond is equal to 6, the first payment, discounted at the 5% rate over a single year, plus 106, that's the second payment, discounted at the 6% interest rate over 2 years. The total value, the price of this bond, is $100.05. To compute the yield to maturity for this bond, we now need to solve the equation. $6 discounted at the rate Y, yield to maturity, over a single year, plus $106 discounted at yield to maturity over 2 years, has to equal the price of the bond, $100.05. It turns out that the solution to this equation is 5.97%. That is the yield to maturity of our bond. If we plug this into the definition of yield to maturity, we see that discounting cash flows of this bond at 5.97% recovers the bond price. As you can see, yield to maturity falls somewhere between the two interest rates. It's between 5 and 6%. It's a lot closer to 6 because most of the cash flows of this bond are paid at time 2. In other words, yield to maturity is some kind of weighted average of the spot rates, but it is not a simple arithmetic average. It's a solution of a somewhat complicated equation, so it's a nonlinear function of the spot rates. Yield to maturity has several simple properties in relation to the coupon rate of the bond, which are useful to keep in mind for thinking qualitatively about how prices of bonds, their coupon rates, and yield to maturity are related to each other. First of all, bond price is inversely related to yield to maturity. As you increase yield to maturity, you're discounting cash flows of the bond at a higher rate, and of course the bond price then declines. The second property is that the bond sells at par, meaning that the price of the bond is equal to the principal payment if and only if yield to maturity is equal to the coupon rate. To see why this is the case, consider a bond with a principal payment of 1 and the coupon rate C. The price of this bond is equal to the sum of its coupons discounted at the yield to maturity Y plus the principal payment, which is 1, discounted at the yield to maturity back to time 0. If we use the formula for an annuity with the rate of return Y, we can rewrite the price of the bond as a sum of two terms that you can see on the right-hand side. The important thing to note here is that if the yield to maturity is equal to C, the coupon rate of the bond, the second term disappears and becomes equal to 0, and the first term equals 1. So the bond price is 1, which is the principal payment. What this equation tells us is that when yield to maturity equals the coupon rate, the bond price is equal to the principal payment of the bond. The bond price is declining as a function of yield to maturity, which means that if yield to maturity exceeds the coupon payment, the bond price is going to trade at the level below the principal. In this case, we say that the bond trades at a discount. It trades below the par value. If the yield to maturity is lower than the coupon rate, then the bond is going to trade at a premium, meaning that the price of the bond will exceed the principal payment. Next, we're going to discuss some of the properties of yield curve dynamics and the models that describe how interest rates of various maturities are related to each other. Let's start with the expectations hypothesis, which is an important theory about properties of interest rates. It is an important benchmark. To introduce this idea, let's consider two alternative investment strategies. Strategy 1 is very simple. We start with the $1 and invest it into a 10-year discount bond. Strategy 2 invests the same dollar into a 9-year discount bond and then reinvests the proceeds of that first investment over an additional 1-year period. Of course, we reinvested at the 1-year spot rate at that time, between years 9 and 10. Under the expectations hypothesis, we assume that bonds do not carry a risk premium, which means that all of these types of investment strategies that move money between time 0 and time 10 by investing in different bonds and maybe reinvesting, they all earn the same expected rate of return. In other words, under the expectations hypothesis, the expected return on strategy 2 has to be equal to the expected return on strategy 1. Let's explore the implication of this idea. First, introduce a new piece of notation. R sub s as a function of t is going to denote the spot interest rate at time t with the maturity s. By default, we are going to set t equal to 0. So we're talking about interest rates at time 0. Consider our two strategies, strategy 1, strategy 2. In the formula, the total return of strategy 1 appears on the right-hand side. It is equal to 1 plus the 10-year spot rate raised to power 10. The expected return on strategy 2 is on the left-hand side. Notice that the realized return on strategy 2 is 1 plus the 9-year spot rate as of time 0 raised to power 9. That's the return on the first leg of the strategy and the investment in that 9-year discount bond, times 1 plus the 1-year spot rate as of time 9. This is the second leg of the strategy. And note that there is a squiggle, the tilde, on top of that interest rate, which reminds us that the spot rate at time 9 is a random variable. It is not known as of time 0. The expectations hypothesis equates the expected value of the left-hand side and the right-hand side. Of course, the right-hand side is not random. We know exactly what the spot rate for a 10-year investment is as of time 0. It's a 10-year spot interest rate. Now, if we rearrange the terms in this equation, we can relate the expected value of a 1-year spot rate at time 9 to the spot rates at time 0 for maturities of 9 and 10. This equation tells us that the expected value of a 9-year spot rate is equal to the ratio of 1 plus the 10-year rate raised to power 10 divided by 1 plus the 9-year spot rate raised to power 9 minus 1. Under the expectations hypothesis, the slope of the yield curve predicts future spot rates. To see what that means, let's consider our formula closely. Expected value of a 1-year spot rate at time 9 can be expressed as the ratio of 1 plus the 10-year spot rate to power 9 divided by 1 plus the 9-year spot rate to power 9 times 1 plus the 10-year spot rate minus 1. Suppose that the 10-year spot rate is above the 9-year rate as of time 0. In other words, the yield curve is upward sloping between years 9 and 10. With that information, we can see that the first term in the formula is going to be at least as high as 1 plus the 10-year spot rate, and so as a result, the expected interest rate over a single year at time 9 has to be higher than the 10-year spot rate at time 0. In other words, when the yield curve is upward sloping, it's telling us that the expected spot rate in the future has to be relatively high. If the yield curve was downward sloping, we would find the reverse, that the expected spot rate at time 9 is relatively low. Now, in a special case, when the 10-year rate is equal to the 9-year rate, using the formula, we can see that the expected value of a 1-year spot rate at time 9 is equal to the 10-year or the 9-year spot rates at time 0. More generally, the expectations hypothesis tells us there is a relation between expected future spot rates and the current spot rates. This is a direct generalization of the equation that we derived in our example. The expected 1-year rate at time t is related to the spot rates for periods t and t plus 1. Specifically, it's the ratio of 1 plus the spot rate for period t plus 1 raised to power t plus 1 divided by 1 plus the t period spot rate raised to power t minus 1. Under the expectations hypothesis, the expected value of the future interest rates is based on the current interest rates. As an alternative to the expectations hypothesis, consider the following so-called liquidity hypothesis. Under this idea, investors regard long-term bonds as relatively risky relative to short-term bonds. For example, if you are an investor with a relatively short horizon and you buy a long-term bond, at the end of your investment period, when you liquidate your position, the payoff is random. It depends on the future interest rates. In contrast, if you invest into a short-term bond, your payoff could be relatively less risky or even fixed. That's one of the arguments that could be used to justify the liquidity preference. More generally, under the liquidity preference hypothesis, the equation that we derived for the expectations hypothesis needs to be modified. The right-hand side is the same. It relates spot rates of different maturities. On the left-hand side, what we see is that in addition to the expected future spot rate, we have an additional term, lambda, which represents the so-called risk premium or a liquidity premium. In other words, the slope of the yield curve over various points down the curve between time t and t plus 1 represents not only the expected future spot rate, but also an adjustment that accounts for riskiness of bonds of long maturities. The implication of this hypothesis is that if lambda is positive, then long bonds on average receive a higher rate of return than short-term bonds. In other words, if you're thinking about predicting interest rates using the shape of the yield curve, this tells us that the spot interest rates of long maturities overpredict the future short-term rates. So if you use the expectations hypothesis formula and you form a forecast of the spot rate using that relation, that forecast is going to be biased. It's going to be upward biased. And the reason for that is that the slope of the yield curve between various points is not equal to the expected spot rate, but also accounts for a liquidity over risk premium. Historically, long-term bonds produced higher average rates of return than short-term bonds. For instance, if you look at the period from 1926 until 2018, the average rate of return on short-term treasury bonds in the US, the treasury bills, has been 3.4%. In comparison, long-term bonds earned 5.9%. This highlights the fact that, on average, long-term bonds produce a higher rate of return than short-term bonds. This empirical fact tells us that the expectations hypothesis does not describe market dynamics very well. Under the expectations hypothesis, average rates of return on long-term bonds and the short-term bonds would have to be the same. Empirically, they're quite different. So why do long-term bonds earn a higher rate of return? Why is there a positive spread or the positive risk premium attached to the long-term bonds? There could be several potential reasons for that. One reason is that short-term bonds are in a way money-like. They are relatively liquid, they hold their value better in the short run than long-term bonds. If investors have needs for these types of securities that are relatively safe over short horizons, then they will be willing to pay more for short-term bonds. In other words, they will be willing to accept lower rates of return on these bonds. The rate of return on cash, on money, is 0, and short-term bonds, which are money-like, accordingly would have to have lower rates of return. That's one argument. Another reason for why long-term bonds may pay higher rates of return than short-term bonds is because they are more exposed to inflation risk. We're talking about nominal bonds here. They lose value when inflation spikes. Suppose there is a news that inflation in the future is going to be higher. This news is going to reduce the value of long-term bonds and is going to raise future interest rates. Short-term bonds are relatively immune to these types of shocks. As a result, inflation risk is going to affect long-term bond investors more than those invested in short-term securities. This could be one reason why investors in long-term bonds would demand a higher rate of return to compensate them for inflation risk. We have seen a couple of theories that talk about various determinants of yields or interest rates across maturities. Expectations of future spot rates, of course, affect interest rates of various maturities, but that is not the whole story. Risk of long-term bonds is also important. So expectations of future rates and their risk ultimately determine the shape of the yield curve. Expectations hypothesis assumes that there is no risk premium, that interest rates across maturities are based on the expected future spot rates. The liquidity preference hypothesis incorporates considerations of risk, but it is not very specific about how exactly risk affects spot rates across the yield curve. There are more explicit dynamic theories of the term structure that develop mathematical models of how interest rates across maturities evolve across time and how their behavior is shaped by expectations of future rates and their risk. Examples of these are the Vasicek model, the Cox-Ingersoll-Ross model, and so forth. You can learn more about these dynamic models of the yield curve in the fixed income course. Next, we consider the concept of interest rate risk, and in particular, we will introduce the concept of bond duration, which is a quantitative measure of risk exposure of bonds. Now, bonds are fixed income securities, but they're not risk-free. If you invest in a long-term bond and interest rates change, the value of the bond will change accordingly. Movements in interest rates are uncertain, they're random, and therefore changes in bond prices or bond returns are also random, they're risky. Now, if you look at the graph here, you could see how the bond price depends on the yield of the bond. The relation is negative. As the yield on the bond rises, the bond price falls. This negative relation is going to tell us how sensitive bond prices are to changes in yields or in interest rates. As an example, suppose that the term structure is flat. All spot interest rates are equal to y. Let's say that at the yield of 5%, the price of a particular bond is $90. If yields suddenly move to 4%, the bond price rises. Let's say it rises to $91.8. The relative price change of the bond is 91.8 minus 90 over 90, that's the bond return, equal to 2%. If we normalize the return of the bond by the change in the yield, the ratio of 2% bond return to 1% change in the yield is 2. In this case, we can think of this number as a quantitative measure of risk. It's a measure of sensitivity of the bond price to changes in the yield. Notice that we've changed the sign here. The yield change is in fact minus 1%. This is a common convention. We want our risk measure to be positive, so we're going to change the sign to achieve that. Now, more generally, we're going to measure risk of the bond by looking at the infinitesimal changes in the yield and how bond prices respond to such changes. This is going to define a measure of bond risk. Mathematically, we're going to measure bond risk using what is called modified duration, which is defined as the negative of the derivative of the bond price with respect to the yield change, normalized by the bond price itself. In other words, this is the infinitesimal change in the bond price in percentage terms divided by the infinitesimal change in the level of interest rates, in the yields. Now, consider as a special case a pure discount bond. This is a T-period bond which trades at the price BT. That price is equal to 1 plus the yield raised to power minus T. If we substitute this bond price into the definition of modified duration, we find that for the pure discount bond, modified duration is equal to T, the maturity of the bond, time to maturity, divided by 1 plus the yield. In other words, modified duration of the bond and its time to maturity are closely linked. For a pure discount bond, modified duration times 1 plus the yield is equal to time to maturity. This relation suggests that there is a physical intuitive interpretation of bond duration. It has a lot to do with the maturity structure of the cash flows of the bond. Next, we introduce a closely related concept, Macaulay duration, which makes it even more clear that bond duration and maturity structure of its cash flows are directly connected. So consider a general stream of cash flows, risk-free cash flows. Call them CFT for period T. We define Macaulay duration as follows. For each tenor T, we compute the present value of the corresponding cash flow. We normalize it by the total value of the cash flow, B, and we use this as a weight. And using these weights, we average the tenors from 1 to capital T. According to this definition, each tenor, T, contributes something to Macaulay duration, and it contributes more if the corresponding cash flow is larger, if it accounts for a larger fraction of the total price of the security. Physically, you could think of this as a definition of the center of gravity of the payment tenors. As it turns out, Macaulay duration and the modified duration that we just defined are directly related to each other, and in fact, modified duration is Macaulay duration normalized by 1 plus the yield. So what we see is that modified duration is proportional to the weighted average of the payment tenors, where the weights are proportional to the present value of the corresponding cash flows. Indeed, the duration of the bond is directly based on the term structure of its payments. Next, consider an empirical example. Instead of computing bond duration based on the term structure of its payments, we can estimate its duration by running a regression of bond returns on changes in yields or changes in interest rates. We look at several examples. We look at 5-year treasuries, 10-year treasuries, and 30-year treasuries. As you can see from the first graph, changes in the price of a 5-year treasury, bond returns, are closely linked to movements in interest rates. There is a very strong statistical relation between them, and the slope coefficient is less than 5. What this is telling us is that the effective duration of a 5-year treasury is less than 5, and that is because these bonds pay coupons, and as a result, the center of gravity of their payments is somewhere between 0 and 5 years. It's close to 5 years because the bulk of the payments comes at the maturity date of the bond. We observe a similar picture for the 10-year and a 30-year bond. Again, bond returns are explained very well by changes in the level of interest rates, and the coefficient, the slope coefficient in these regressions, is closely related to the maturity structure of the bond payments. It is under 10 years for a 10-year bond, and it's somewhere between 0 and 30 years for a 30-year bond.
In this question, we will learn how to compute bond convexity, and we'll learn how to use it to approximate the change in the value of our holdings or in the value of the bond. So we'll assume that the yield curve is flat at 3.5%. We will assume that there is a $100 face value bond that pays annual coupons and has 5 years to maturity. The coupon rate is 5%. So first, we will compute the modified duration of this bond. Second, we will compute its convexity. Then we will use modified duration of this bond to try to find the approximate change in the value of the bond when interest rates drop or the yield curve drops by 1.5%. This is exactly what we've done in question 6. Then we will actually use convexity, the one that we compute in part B of this question, to find the approximate change in the value of the bond when interest rates drop by the same 1.5%. And then in the last part, we'll compute the actual change in the value of the bond. And then we'll compare that actual change to parts C and D of the question and see how well both parts C and D approximate the actual change in the value of this bond. Let's start by computing the modified duration of this bond. So this is very similar to what we've done in question 5. And the spreadsheet has the same template. The only difference is that this bond has 5 years to maturity. So the YTM on this bond, the current YTM is 3.5%. Its face value is $100. And this bond pays 5% annual coupon. So here we have the cash flows that we get from this bond. And the first step, what I will do is that I need to compute its price. So I will compute the present value of this cash flows. So we already done this calculation several times. And so if I compute present value for each of these 5 payments, I add them up. This will be the price of the bond. Again, I always recommend making sure that the price of the bond makes sense. So in this case, we expect this bond to be priced at a premium because the coupon rate on this bond is higher than its yield to maturity. And so the price of the bond 106 is above the face value of $100, so that this makes sense. So now the next step, I will compute the present value of each of these individual payments and multiply it by the year in which it occurs. I will add them up as well. And then I will compute the Macaulay duration by taking the sum and dividing by the price of the bond. And so this would be the Macaulay duration of this bond. So it's 4.56%. Again, recall the other check is that we expect the Macaulay duration here because this is a coupon paying bond. We expect the Macaulay duration to be lower than the maturity of the bond. So the maturity of this bond is 5 years. The Macaulay duration is 4.56. And finally, the modified duration is just the Macaulay duration divided by 1 plus the current yield. So the answer here would be that the modified duration is 4.41.
Bond duration can be used as a measure of bond risk. Now let's take a closer look at how well bond duration approximates a risk of the bond. Consider the following example. We have a 4-year treasury note with a face value of 100 and a 7% coupon, which is paid semi-annually. So every 6 months, this bond pays $3.50 in coupons. In the following table, you can see the cash flows of the bond. It's $350 every 6 months and a payment of $103.5 at the maturity date. Now, for this bond, we can compute the Macaulay duration as a weighted average of the payment tenors, and that happens to be equal to 7.13 periods. Each period is half a year, so this is a little less than 4 years. And the modified duration, which is Macaulay duration divided by 1 plus the yield on the bond, 1 plus 3%, is equal to 6.92 periods. So it's a little bit shorter than 3.5 years. Based on this number, based on the modified duration, our infinitesimal formula can be used to approximate risk exposure of the bond. The formula tells us that when the semi-annual yield moves by 0.1%, the bond price should decrease by roughly 0.692%. The approximate change in the bond in percentage terms should be equal to the modified duration times the change in the yield. Now, this approximation is based on the infinitesimal analysis. It's based on the Taylor approximation, Taylor expansion of changes in the bond price. What happens if yields move by a larger amount? Is this formula going to remain accurate? Let's do an experiment. We're going to change yields by larger amounts and see how the bond price responds. In the following table, you could see the price of our bond exactly computed as a function of several different values of the bond yield. In the middle of the table, we see that when the bond yield in semi-annual terms is 3%, the price of the bond is 103.5. Now, we can compute bond price for different yield levels exactly, or we can compute it approximately based on the modified duration number. What we see here is that when yields change by 10 basis points from 3% to 3.1, the exact bond price moves from 103 0.5 to $102.79. And the duration-based formula is producing a highly accurate approximation. It's giving us basically the same number. So the difference shows up in higher order digits past the decimal point. Now, let's assume that the yield changes by a larger amount. It goes from 3% to 4%. Now the price of the bond drops to $96.63. That's the exact bond price. And the approximation based on modified duration is giving us $96.35. Now we can see that there is a difference. The duration-based formula is under-predicting the bond price. The exact price is higher than what we get based on the duration formula. This is not surprising. The modified duration is a first-order approximation to price changes of the bond, but the exact relation between the bond price and the yield is nonlinear. Therefore, when changes in the bond price are large, we need to think of higher-order approximations. We can see this intuition clearly in the following graph. The red line here corresponds to the exact price of the bond as a function of the yield. The blue line is a linear approximation. It's giving us a very accurate description of the bond price if changes in the yield are small, but it kind of falls short when changes in the yield are large. This blue line corresponds to the duration-based approximation. Our duration number is giving us the slope in the relation between the bond price and the yield. If we want to account for the nonlinearity, if we want to capture the most important nonlinear term, the curvature of this curve, we need to introduce higher order terms. So curvature or convexity of this curve need to be captured by an additional term, and that term is called the convexity term. Algebraically, what we can do is expand the bond price in a Taylor series as a function of changes in the bond yield. The leading term, which is a derivative of the bond with respect to the yield, times the change in the yield, the first order term, is captured by the modified duration. Modified duration is the negative of this derivative of the bond price with respect to the yield. The second order term in the Taylor expansion, the quadratic term, is what we call bond convexity. So from the Taylor expansion, we can see that the natural definition for bond convexity is 1/2 of the second derivative of the bond price with respect to the yield divided by the bond price itself. This second order term is going to give us an additional degree of approximation that goes beyond the leading term, the duration-based term. Let's see how much the convexity term helps when we approximate bond price changes under large movements in the yield curve. Suppose we are looking at a 10-year bond with a 10% coupon and a 10% flat yield curve. The modified duration of this 10-year bond is 6.23 years. Now, if you look at the column in the center of the table, this corresponds to the initial position of the bond. That yield change is 0. There is no movement in the price. We are now going to consider different changes in the yield. For example, what if the yield on the bond moves up by 100 basis points or by 1%? The total change in the bond price is going to be minus $6. The bond price falls by $6. The duration-based approximation would tell us that the bond price falls by $6.2. There is an approximation error of 20 cents. The convexity term is going to correct that to some degree. It's going to give us plus 30 cents. At the end of the day, when we sum up all of these terms, we see that the approximation is quite accurate. The error is less than 10 basis points. If the yield change is larger than that, for example, 300 basis points, 3%, the total decline in the bond price is going to be $16.50. The duration-based approximation is going to be relatively inaccurate. It will give us $18.70 decline. The convexity correction is going to be $2.40, and the overall error is going to be quite modest, about 20 cents. What we see from this illustration is that the convexity approximation, the convexity term, provides a useful degree of correction when we are concerned with large movements in the yield curve. We now consider another important dimension of bond risk, which is inflation risk. Bond payoffs are nominal. As a result, as the price level changes, as inflation rate changes, the real value of the bond is affected. Real payoffs are affected by inflation. So let's recall what inflation is. Inflation is the rate of change of the nominal price level. If you're thinking about prices of consumption goods, let's say price of a burger, it may be $5 this year and $6 5 years from now. What this means is that for the same consumption good, the nominal price level is changing by 20% over a 5-year period. This change, this process of changes in nominal prices, is what we call inflation. As the price level rises, the real value, the purchasing power of a single unit of money, let's say of $1, falls. So the purchasing power of currency and the price level are negatively related. As a result, payoffs on nominal securities, like bonds, are sensitive to inflation. As inflation rises, the real value of the payoffs declines. So let's look at the following example to illustrate the point. Suppose that inflation next year, realized inflation rate, is uncertain. On average, we expect inflation to be 8%, but in reality, it could be higher or lower. Let's say that there are 3 possible values, equally likely: 10%, 8%, or 6%. The real interest rate is 2%. This is the risk-free rate of return in real terms, not in nominal terms. The 1-year nominal interest rate is approximately 10% to correct for inflation. As a result, depending on the realized inflation, the real return on a 1-year treasury bond is going to be different. If inflation happens to be 8%, exactly as expected, the nominal payoff of the bond, which is $1,100, is going to be worth $1,019 in real terms. If inflation happens to be higher than expected at 10%, the same nominal payoff is going to be worth only $1,000 in real terms. If inflation is lower, 6%, that payoff is going to be more valuable. It's going to be $1,038. The point is that while nominal securities like treasury bonds may produce safe payoffs in nominal terms, their payoff is risky in real terms. Inflation risk is particularly important for long horizon investors who are concerned with accumulating wealth. For example, if you're thinking about a household saving for retirement, it would care a lot about the purchasing power of their savings rather than the nominal value. And for them, inflation risk would be a first-order concern.